Welcome back, investors, to Ticker Time News. I'm Adam. Thank you for joining me for the After Hours show. And wow, what a turnaround in the market today. The markets were heading for a big down day. I mean, a really big sell off this morning, but the market bought the dip and it turned it around because the market was oversold dramatically in this afternoon. And so investors decided collectively to let's buy the dip. And that's what happened. So hopefully you didn't panic sell this morning like a lot of people did. And hopefully you held on strong and you were able to stay in it because nothing beats time in the market. Nobody can time the market. I myself, I did not think that once the sell-off started this morning that it would end. I figured the bell would have to be rung at 4 p.m. Eastern for the falling to stop. But to my surprise, it turned around. Nobody can time the market. So it's always better to be in the market because that beats anything. Now, I know there are stories out there of people who have been in a down market and it has taken years to get back to zero, to get out of that red ink. And that's why when you are starting new positions, it is so important to use a stop loss strategy, whether it's a fixed price, fixed percentage, or a trailing stop loss. It's very important to do. That way, you don't end up buried under mountains of red, right? Holding bag after bag after bag after bag. You're able to get out before it goes too low. And again, it's your strategy. It's not what someone on YouTube tells you to do. It's your own strategy that works best for you. All of us investors, we're different. We think of investing strategies slightly different from the other person. And that's important. That's good. That way we all can learn, well, what's the best way to handle a downturn in the market? And that's one thing we're going to talk about today. The best ETFs to put your money into, they're very risky. I'll say that up front. They are very risky, but so far, one of the ETFs is up 50% so far in 2022. So they do work, but they're specifically designed for markets that are in a downtrend, going down. If you would have jumped into one of those ETFs this morning, you would have made a nice percentage gain, maybe up to 10%, until the market started to turn around. Then those strategies don't work. But I'm not sure that this rebound we had today can hold. That's my fear, is that the rebound we saw today was that the market was oversold. So investors stepped in to buy on valuations that were down, right? But I don't think the selling is over. You have to watch out for what's called bear traps and bull traps, right? Well, we have to watch out for bull traps right now. That's when a market seemingly turns around and it's headed up, but then the very next day it can all come crashing back down. So we're going to talk about strategies that you can use for a down market, okay? But I also want to talk about this market in a way that I haven't talked about this market before. So first, I do have to acknowledge, like I said at the onset, that we had a big turnaround today in the market. It was a really nice feeling to see that. But stocks erased their losses from this morning, this afternoon, as buyers took advantage of low valuations. Now, traders remain cautious ahead of big tech earnings reports this week, including IBM, Microsoft, Tesla, and Apple, which started finally pricing in, or I should say the market finally started to price in, the Federal Reserve may be raising rates 3 to 4 times this year, and quantitative tightening. Instead of the quantitative easing, quantitative tightening. That's taking stimulus or money out of the market. The Dow was up more than 100 points after dipping more than 1,100 points earlier in the session. Like I said, this morning I thought it was over with. And the S&P 500 and both NASDAQ both turned positive after declining more than 3%. What a crazy day. What a crazy day. But now let's talk about this market, okay, in greater detail. So far, 2022 has not gotten off to a good start. The NASDAQ has suffered a correction, which is loosely defined as a 10% pullback from a prior closing high. The Russell 2000 has flirted with a bear market, which is loosely a definition, or a loose definition is a pullback 20% from a closing high. The S&P 500 and Dow Jones both fell below their 200-day moving averages. The S&P is still below it. A rush to buy every dip in 2021, that has been overtaken by a preference to sell into strength in 2022. The 10-year yield, it went from 1.51% to 1.9% in just 11 trading sessions. The Fed funds future market, which only a month ago thought three rate hikes in 2022 was a close call. It is now projecting 4 rate hikes in 2022. Furthermore, there has even been some chatter that the Fed will raise the target range from the Fed funds rate by 50 basis points at the March meeting to try to regain some inflation fighting credibility. As a reminder, the target range for Fed funds rate is at the zero bound, while the consumer inflation rate of 7% sits at a 40-year high. That inflation has been driven by higher prices for goods and services, which have been amplified by supply chain problems, transportation bottlenecks, and underinvestment. In due course, another inflation driver avail should itself show as a problem: wage inflation. Wages are going up. Goldman Sachs CEO David Solomon, he captured the reality well in his earnings conference call, saying that, and I'm going to summarize, there is real wage inflation everywhere in the economy. Everywhere. He said this after the bank reported much higher than expected compensation expenses that led to an earnings miss and a year-over-year profit decline. Shares of Goldman Sachs declined 7% the day of its report. It is not a bad thing that wages are increasing. It can become a bad thing for the stock market, however. Now, if that wage inflation cuts into profit margins and or leads to higher prices, that is inflation, to protect profit margins, we've got some issues. Something a lot of new arrivals to the market might need to get acquainted with is the understanding that earnings ultimately drive the stock market. If profit margins are expanding, they will be allocated for, and investors will pay more for every dollar of earnings. If they are contracting, then investors won't pay as much for earnings growth that is either decelerating or declining because of the margin pressure. That's one issue. Some, perhaps many companies, may be successful with passing along their higher labor cost in the form of higher prices for their goods and services. These companies would benefit from an expansion in profit margins, assuming customer demand holds steady or even increases. This is the other issue. If more and more companies are looking to offset higher compensation expenses with higher prices for their customers, there's going to be wage based inflation pressures that are apt to prove stickier since employers aren't going to start cutting wages when when their competitors aren't either. At least they accept the risk of losing a bunch of employees if they do. This stickier wage push inflation will be an added component that compels the Fed to keep these inflation pressures in check with higher interest rates. We are at this crossroad right now. Only there isn't a good turn in any direction we can take. Individual companies reporting profit margin pressures during the Q4 reporting period, they're going to be penalized and have already been penalized. Whereas the broader market is going to be penalized by a more aggressive Fed that sees a risk of wage based inflation pressures leading to more persistent inflation. It's somewhat of a lose lose position, or at the very least, a position that is going to make multiple expansion much harder to come by in 2022. Companies are literally going to have to earn their way this year, which is way which is why many of the profitless story stocks of 2021 risk being left further behind in 2022. That can be a problem. What it all means, though, is that the Q4 earnings reporting period is about to go full throttle. There have been early warning signs that it could be a more challenging reporting period, certainly in relation to recent reporting periods. That might sound ridiculous against a backdrop that includes an estimated blended earnings growth rate of 22.8%, according to FactSet. It resonates, though, in the understanding that it will be the slowest earnings growth rate since the fourth quarter of 2020 and precedes a quarter where earnings growth is projected to be just 6.2%. It also resonates knowing the Fed is on the verge of increasing its policy rate at a time when labor supply that is, remains tight, necessitating necessary higher wages to attract and retain skilled workers. Oil prices are at a 7-year high, and supply chain improvement has been impeded by the Omicron variant. We should be hearing a lot about higher costs for corporate America, ranging from raw materials to transportation to packaging to labor. We don't expect to hear a lot about anticipated cost relief in the first half of the year, nor do we expect companies to project a lot of confidence in their forecasting ability for the full year. The element of positive surprises this reporting period is unlikely to be what it used to be, while the potential for negative surprises, not so much in the actual reports, but for Q4 and its guidance for Q1 is inflated, like wages. Also, remember that now is the perfect time to put together a shopping list for companies that you want to own with a price target and set stock alerts just above these price targets. So that way, as the market continues to fall and you start getting the stock alert notifications, you can buy these great companies at a reduced valuation and a better entry point. Here's 4 examples. First being Alphabet, okay? GOOG. Let's look at Alphabet. All right, load. There we go. All right, Alphabet today, it closed at 2607. Today, during the fall, the mighty fall, Alphabet got as low as 24.92. Now, as the example here, Alphabet, a good, steady, strong company, a good balance sheet, good cash flow. It's a solid company. Now, I would put a price target, since we're coming down this low, of $2,400. At $2,400, the forward PE ratio is 19.8 times. Not too bad. And that's at $2,400. It was only $92 away from that earlier today. So it's definitely doable. As a matter of fact, since it was so close to reaching it, maybe lowering that price target might be better. All right, the next one that I want to use as an example is Microsoft. Now, again, another solid company. Microsoft, MSFT is the ticker symbol. There we go. Now, Microsoft today, it closed at $296, and it got as low today. Let's get that lined up there. It got as low today, $276 today. Now, I would put a price target of, and these aren't price targets of where the stock is going. These are entry price targets. Where would be a good place to enter this stock? So my price target for Microsoft would be $250. The forward PE ratio at $250 is 27.6 times. It got close, within $25 or so of that price target today. And again, since it got that close to the price target, maybe lowering it might make sense. Okay, next one that I want to look at is Home Depot. Now, Home Depot's ticker symbol is HD. Now, for Home Depot, they closed at $363. They got as low today as $343. Now, for Home Depot, I would have a price target of $300. At $300, the forward PE ratio is 18.75 times. Those are 3 examples of how you create the shopping list, right? You find companies that are down below their 200-day moving average, that are solid companies, have good growth rates, right? They have a good balance sheet. They've got cash flow. You put them on your shopping list, You set a price target. You set a stock alert. Now, many applications out there have stock alerts. If you need an idea for where to go, click the link in the description for TradingView. They offer a free account and you can set stock alerts very easily. When you're in the app, if it's on desktop here, I'm going to go down to $300 here, which seems like a long ways away, but it's not really. I click this plus icon there and then draw a horizontal line, which you can do that to help you track, or you can set the stock alert, which also puts a dotted line there for you. So I'm going to go back to the $300 mark here. There we go. And at the very top, it says add alert for HD, $300.30. You can click that, or you can click to add an alert for the 20-day, 50-day, 200-day moving averages. You can set buy orders, sell orders in here. You can create something new if you want. So there we go. Set a stock alert. So now it adds this dotted line, and that's where I've got the stock alert at $300 for Home Depot. And again, it seems like a long ways away, but if we go back and look here, why am I picking $300? Well, the valuation for one, the forward PE ratio for two, and for three, if we're looking at how far could this thing actually come during a correction, where's a low point where support kicks in, and $320 is another area where support really kicks in. I'm going to draw a line there. $320. I mean, maybe you set a stock alert there if you wouldn't mind paying a little bit more for the forward PE ratio, a little more for the valuation. Or the next area would be this $300 area. It's the last area of support after this rally right here. And this rally occurred back in 2021. Nice straight up rally solely off of earnings and future guidance. So that's a good area right there. And that's why I'm picking $300 as a shopping, why it's my price target on my shopping list. So go through even companies. Now, 2022, I believe, is not going to be a very good year for growth companies. And just let's look at Enphase for a moment. ENPH. There was recently an upgrade for Enphase, but there was also a negative report thrown over solar. So while I love Enphase, it's probably a company that isn't going to do so well in 2022 just because of our environment that we are in, right? So set yourself a price target for Enphase and go low on it. Like if we look at the last big, well, I won't say the last big rally because that was right here. Let's go further back. This last big rally that occurred here in 2020 and topped out in 2021. If we go find an area of support down here, maybe $95. Enphase today, it got as low as $113. So if we're looking here at support areas, we've got a little one here at $100, but we also have one at 95. So maybe somewhere in between there. So what I'm going to do is I'm going to set a stock alert at $100. 99.99. I'm going to set a stock alert for in phase right there at $100. I think it can totally come down to that and probably surpass that, falling further. Maybe going to 65. That's a possibility. I'm actually going to add one here at 65. Oh, that's not what I meant to do. I'm so used to clicking on the horizontal line that I added another horizontal line there. All right, 65, 75. I'm going to put a stock alert for that price point. I think it in this year, 2022, it's doable. How about another one that is a growth company that a lot of investors like in a completely, what about Matterport, right? Matterport, MTTR. Let's look at that. Matterport is now a $10 stock. Can you believe that? Back here, when Matterport was running up into the $20 to $30, would you have believed me if I would have told you that Matterport was going to $10? Would it have been a surprise if I would have said that Matterport's going to $5 a share in 2022? See, the growth companies get hurt the worst. So for Matterport here, I'm thinking I need to go down to $5. I need to go all the way down to $5, which doesn't even show up on my stock chart here. I've got to tighten the chart up in order to get $5. So I'm going to set one here at right here, 502. I'm going to set a stock alert. I think it can get there. If we measure where it closed today, and it did close in the green, up 1%, where it closed today to where that is, that's another 51.2% decline. It's doable. Maybe I'm going to put another stock alert here at $8. And we'll see what gets triggered. Hold on. There we go. All right. So, a shopping list for solid companies is great. If you're going for these growth companies, then the whole point that I'm trying to convey is that you want to set the bar really low for growth companies because they will get hit pretty hard this year. Unlike Home Depot or Microsoft or Alphabet, they'll fare a lot better. And even maybe there's some banks that you like. Ally Financial, Wells Fargo. Even Morgan Stanley pulled off a really good earnings report this past last week because they were able to balance out a really diversified income stream. And they were able to put a lid on the rising compensation problem that the other banks faced. Okay, as another reminder there for investors to help guide investors towards quality stocks in this rocky market. We've put together our top 10 stocks list in 4 different categories: value, growth, dividend, and momentum. I know I mention this every day, but I truly do believe in these lists of stocks, and they are constantly being updated. Now, these lists are updated. Oh my gosh, I'm getting tongue-tied. These lists are updated, so you always have the best names available. Just click the first link in the description to become a member and get instant access to our top 10 value, growth, dividend, and momentum stocks. That's 40 high quality names ready to choose from, constantly updated. We've done the research so you don't have to. All right, let's look at gold, GOLD today. It didn't move much, but the last time I checked, it did have a green day, and it looks like that flipped to red. So as the market flipped today, so did gold. Gold was slightly positive today. It's at 1842 an ounce right now. And let's look at Bitcoin. We always do every day. BTC USD. It also kind of reached a bottom and bounced just like the market. And it's at 36,376 right now. So it's seemed to have found a bit of support down here. What I need to do is take this yellow box here, and I'm just going to clone it because I don't want to change it up too much. And I'm just going to bring it down here because it fits perfectly with the bottom of the needle for the candle or the wick up to the top of the candle here. But it doesn't get the top of the wick, but it does capture the bottom of the wick and the past 3 candles there. So let's see, is it going to stay in this box here? Is it going to move or what? But Bitcoin today, it got pretty low. It got to a low of 32,933. 32,933. That is pretty low for Bitcoin. Now, I myself bought a little more Bitcoin today. I also bought a little more Ethereum today. Those were some pretty steep prices. I wasn't sure this morning where this market was going to take us because it seemed like it was going to take us lower. Even though there were a few highlights in the market that weren't being dragged down. But boy, oh boy, you know, that 1 out of 10 times where the death cross actually means something besides a lagging indicator, it meant something this time. And you know, I got that one wrong, so I have to admit it and be honest about it. All right, let's check in on Ethereum, ETH, USD on TradingView. Now I use Coinbase as my data source. All right, so Ethereum's at 2414. It is below its bottom trend line. It fell below that a few days ago, but it, like Bitcoin, it's holding this line right here, right at 24.25. 24.25. It seems to be a line that has been holding the past few days here, maybe as low as 24.20. In between there has been like the bottom of the candle itself. The wicks have fallen a little bit further. Let's check in on Cardano, ADA, USD. Well, it didn't dip below $1, so it's at $1.06 right now, and that seems to be, if you look at going back here to, what would this be, March of 2021, so just about a year. uh, it really let me fix this chart. I forgot I messed it up. uh, Going over the past year, this bottom where it's at, it has been a bottom that has held all through 2021, and it interacted with it. What's this? One, two, three, four, 5 times in 2021. It acted with it, and then so far in 2022. One time a wick came down to it, but the candle did not. And then now, over the past few days, the candle has, the wick's gone past it though, but the candles have been resting on it. And that's at $1.05. So holding up pretty nicely there for Cardano. Okay. At the very beginning, I said I wanted to give you guys some ETFs that work in a down market. Now, volatility, that's when price is going up and down and up and down. That's volatility. Volatility continues to be very high ahead of the Fed's FOMC meeting this week. That could be the start of rate hikes and growing concerns about stimulus reduction for the markets. We talked about that already. Now, there are bear or volatility ETFs that work as a great place to make a positive return during market downturns. I'm going to give you 5 ETFs that you can use when the markets turn negative. Okay? First up is ProShares Trust Ultra VIX short-term futures ETF. The ticker symbol is UVXY. Now, let me show you this. This thing was positive this morning. It ended positive 2.7%, and after hours, it's 1.8%. Now, in 2022, so far, year to date, this is up 51.9%. 51.9% year to date. So for the entire month of January so far, for the entire year of 2022, it's up 51.9%. And what this thing is doing is the opposite of what the VIX is doing, in a way. When the VIX goes up, then the price for this ETF also goes up. When the VIX goes down, then the price of this ETF goes down. All right, so 51.9% year to date. That is pretty good. All right, the next one I want to share with you is ProShares Ultra Pro Short S&P 500. It's SPXU. That's the ticker symbol. SPXU. Now, if you want to short the S&P 500 and you don't know how to play with options, then you can do an ETF that is doing the options play for you. Now, this one right here, let me blow it up here. For 2021, it's up 27.6% year to date. 27.6% year to date. So for the month of January, it's up over 27%. Now, today, it closed at 1549. It was down 1.2%. It's up a 30% in after hours. But today, it got as high as 1752. So if you wanted to make a day trade and make a pretty decent percentage-wise, you could have done that. But once the market started to turn around and go green again, or start moving towards that, that's when this started to pull back. This thing was up over 10% at one point today. If we go from the open this morning to the top, I got to move the box out of the way so I can see, to the top of this thing, it was up 13.3% today before the market turned. But for September, it is up 27.6%. So if the market takes a downturn, you can park some money over here and earn a gain while you're waiting for the market to turn around. Now, these ETFs, the reason I can say, or the reason I do say they can be very risky, is because if the market does turn around rather quickly like it did today, I mean, this morning, everybody thought the market was over and we were going to crash. But it turned around. So if you would have piled into this in a small account, you had no day trade ability left in your account, then you would have wound up being down however much, right? Because the market turned. But these can be a great place to park your cash when we are in a downtrend. All right, the next one I want to share with you is also a ProShares ETF. It's the ProShares Ultra Pro Short QQQ. So if you ever wanted to short the QQQ, this is how you do it. It's S and then QQQ. That's the ticker symbol. Okay? ProShares Ultra Pro Short QQQ. Now, this one made a pretty big turnaround today. But year to date, for the month of January, it is up 43.2%. 43.2%. And what do we have here? Today is the 24th. So in 24 days, this is up 43.2%. So remember, when the market goes negative momentum, when the market is in a downturn, when the market is bearish, there are ways to make money. This is one of them. Okay, let me just measure and show you what today did. So if we go down here to the bottom to the top, so the spread for today was 17%. 17%. So this thing at one point was up 17% today and then closed down 1.2% because the market flipped. So that's why you have to be careful with these. Okay. Now, the next one I'm going to show you can give you outsized returns, but it can also give you outsized losses. And that's because this is a leveraged ETF. It is leveraged. It's using margin. Okay. This is the MicroStrategies Thang Index 3 times inverse leveraged. The ticker symbol is FNGD. FNGD. Okay. This one does really, really good when Thang does bad. And it's Facebook, Amazon, Netflix, and Google. Netflix being dropping by wow, right? Netflix fell hard. And because Netflix fell hard, this skyrocketed. But this one's up 49.7% year to date for the month of January so far. 49.7%. It is up. So when the market is down, now you have 4 different places you can go to get a gain. These are very important to know about, okay? Every single YouTuber should be talking about ways that you can easily make gains in the market when the market is in a downtrend. But I don't hear anyone doing it. I hear Meet Kevin saying he's selling out of the market. Well, what good is that going to do? Now you have to pay all those taxes. Maybe he did some tax loss harvesting at the end of the year. I don't know. Maybe he had a leverage call. I don't know. But Meet Kevin's advice is to sell out of the market altogether? No. There are ways to make money when the market is going down. And selling out of the market is not, in my opinion, the right choice. Remember, time in the market beats timing the market, period. It's proven. It's not like that's an unsettled theory. So this is the MicroStrategy Fang, as in FANG, okay? Now, this one today, let's see what the swing was today from the bottom to the top. I'll move the block out of the way. Bottom to top was 19% today. And it's up 49.7%. Now, I know Netflix had a lot to do with it. That's this gap up right here. But this down market also continued it. I mean, it was up 3.4%. It's up 0.5% in after hours. People are running to this and jumping into it because the market is in a downtrend. Nobody expects the bounce that the market had today to last, right? I don't expect it to last. We haven't had a real bounce and recovery yet this year. They've been convictionless. So I would need to see 2 solid days of recovery and see the indicators splash positive momentum instead of negative, positive momentum, and 2 solid days of green before I think this market is turning around. Okay. With this said, with these ETFs pointed out, okay, I have one more for you. This is for being bearish on small caps. It's another leveraged account. TZA is the ticker symbol. TZA. This is if you want to go short on the small caps, which have gotten beaten up lately until today. This thing was down 7.2% today. It is up 36% year to date, or 36% for the month of January so far. But today's turnaround took some of the gains away. As a matter of fact, let's see what the swing was on this one. There's the bottom and there's the top. 18% swing today from bottom to top. This thing opened at, what was this, 39.79, and then closed at 35.36. Now, it's a leveraged account, So you have to be careful. But instead of getting out of the market, put your money into ETFs that are, I mean, the whole reason these things exist are for down markets. Okay, now this is important. Leveraged funds, like the 3X one, this one right here, they greatly increase risks with some moves over 20% in less than a day. Okay, it's kind of like crypto. If you choose to trade these types of funds, I highly recommend you consider a stop loss strategy, or at the very least limit your exposure to the amounts for which you are comfortable taking on, because they are risky. Look at today. Today it swung pretty hard, and it swung to the downside. So do be careful, but selling out of the market just to get back into the market may be an investing strategy that I don't know about. But if you want to trade and you want to make money, then the ETFs I just showed you are ways that you can make money in a down market, and you don't have to know how to use options, okay? So I hope you take advantage of them, but do remember they do come with added risk, just like using options. Options come with a greater risk than, say, just buying a simple share or two of whatever company. Okay? But this is real easy. You're buying a share or two or 100 or 500, whatever it may be, of these ETFs. So if the market is going down, you can make money. And there is different strategies that you can use with these ETFs. But if the market is dropping, you don't have to lose your money. And you don't have to exit the market altogether either. So I hope you guys get this. I hope you understand it. I hope it makes sense. It's pretty good. All right, let's talk about coals. We've talked about coals before. KSS is the ticker symbol. We talked about coals before. And might be a little M&A going on here. But coals was up 36% today. Now, coals is in our dividend stocks, or it was the last week, the last time we updated it. But I think it rotated out this past week when we updated the list. But they were in it. So coals, let's go like this. Coles likes to put items on sale, but some private equity firms want to buy the whole company. The department store giant has been struggling, to say the least, with sluggish top-line growth, and inflation is expected to weigh heavily on its earnings in the coming quarters. Its challenges can be blamed partly on the pandemic, but it has underperformed peers that are facing the same industry headwinds. Now, I've talked about Kohl's before as a dividend stock idea back on our January 13th live stream. The stock was at $49 and some change. I can't quite remember a share. And that's a 28% jump since then. So I'm happy to see today's announcement of takeover interest, just like Microsoft took over or is planning to take over Activation Blizzard. Kohl's confirmed today that it has received letters expressing interest in acquiring the company. The company did not provide further details about the feelers it has received, like which firms are involved and what the buyout price could be. However, the Wall Street Journal did report that the Starboard Value Consortium was aiming to bid around $64 a share. And CNBC reported yesterday that Sycamore is willing to pay at least $65 a share. The press release from Kohl's notably says letters, implying that at least two offers are in play, maybe more, which backs up the reporting. The company said that it will determine the best course of action and will not comment further. The prices reported would be a nice premium from Friday's close of 46.84, and that would be about a 37 to 39% increase. Activist investors have been nibbling on or at the board of Kohl's to take some action for some time now. In fact, Kohl's reached an agreement with major investor McCallum in April of 21 to add two of the firm's people to the board of directors for Kohl's. The company has also been enacting a strategic turnaround plan by trying to rebrand itself away from its discount model towards focusing on active and casual lifestyle products. Among recent endeavors, it reached a store within a store partnership with Sephora to launch Sephora at Kohl's in a total of 850 locations by 2023. And it partnered with Amazon to allow customers to return items, which helped drive traffic to Kohl's stores. However, activist investors want more steps to be taken. For example, activist investor firm Engine Capital recently sent a letter to the board arguing that Kohl's should consider spinning off its successful e-commerce segment, Kohl's.com, which the firm thinks could fetch a $12.4 billion market cap on its own. Jana Partners is advocating for Macy's to take the similar step. Another potential move for Kohl's could make it so to monetize some of its real estate assets. Unlike a lot of retailers, Kohl's does own a lot of the real estate in which its stores are positioned on. Kohl's could conceivably sell a lot of the land and do a lease back with the real estate company, potentially unlocking $3 billion in cash. But Kohl's has rejected that idea. Bottom line for Kohl's, Kohl's has been a serial underperformer, and if its stock could move or could not move forward after Q3's huge beat, maybe it should consider a spinoff of its online unit or sell some real estate. I think taking the company private, making changes, then allowing the company to reemerge as an IPO in a few years is just what is needed, because the market is not rewarding Kohl's with a proper multiple. However, management has been resistant, so it may be advisable to keep hopes in check. If Kohl's does remain public, the main concern for its performance is supply constraints. Kohl's has a good amount of production coming from Vietnam, where COVID-19 shutdowns have weighed on output. To its credit, Kohl's says it took such risk into account when it recently increased its full-year adjusted EPS guidance to $7.10 to $7.30 from prior guidance of $5.80 to $6.10. The new guidance would be about a reasonable PE of about 8.7 times at the midpoint and a forward PE of only 9.4 times. So the stock is quite cheap even after today's massive move. Okay, let's talk about Catalyst Watch for tomorrow. Now, today was a big turnaround day in the market, but we do have to talk about a few things, one of them potentially being negative about tomorrow's market, particularly Robinhood, ticker symbol HOOD. Oh, I put too many O's in there. Robinhood Markets. The IPO lockup period expires on Robinhood tomorrow, which could provide a healthy dose of extra selling pressure on the stock. Although Robinhood is 65.3% below its IPO price. Robinhood reports earnings on Thursday after the market closes. So, what could we see from Robinhood? Well, on their earnings report coming up on Thursday, I'd be watching how active traders are because at the big banks, fixed income trading has declined. At Jefferies, over 49%. So is Robinhood still seeing the same amount of trading or is it declining? I'd be curious. I don't expect Robinhood to do much. I am surprised that it was up 1% today. But that was an overall buy the dip, low valuation. Let's do it, market. Okay, so that's one for tomorrow. The IPO lockup period ends, meaning certain people with the company are allowed to sell shares for the first time. And, you know, being over 60% below its IPO price, they might not be so willing to sell their shares right now. They may want to just hold on to them and wait and see. At least that's what I'd do. All right, next up, we have the 3-day GamesBeat and Facebook Gaming Summit, and they will feature a big focus on Meta platforms, ticker symbol FB, and their aspirations in the metaverse. The whole reason the name change was done, the metaverse. Look at Facebook up 1.8% today. After, how low did it get today? It got to $289. $289, and it closed at $308. All right, so gaming in the metaverse, that is huge on people's watch list right now. And of course, we've got the huge Microsoft Activision Blizzard deal, and that has turned a brighter spotlight on what Meta plans to do in the gaming space, and especially with the metaverse. So watching that tomorrow. Then we get earnings before the market opens from Johnson & Johnson, ticker symbol J&J, Verizon, ticker symbol VZ, Lockheed Martin, LMT, and American Express, AXP. And then in the after hours, the earnings I'm watching is Microsoft, MSFT, and Capital One, COF. Now, earnings tomorrow for Microsoft after the market closes. It's too soon for anything related to the Activision Blizzard takeover to show up in earnings, okay? So you have to wait for that one. All right, that's all I wanted to talk about in today's video. If you found this video to be helpful, informative, actionable, then click the like button and take the URL and share this video everywhere. That helps us all reach financial freedom. And then lastly, if you found my perspective to be helpful, insightful, actionable, then click the first link in the description and become a Patreon member today. That's where you get our top 10 growth, value, dividend, and momentum stocks list, and so much more. We've done the research so you don't have to. All right, ladies and gentlemen, I'll wrap it up right here. Hopefully, tomorrow will be a better day in the market, but as you know, we can't just run on hopium. We need to run on being a realist and understanding that we don't have to jump out of the market. We can make money even in a market that is declining. All right. Thank you, ladies and gentlemen, for watching. I greatly appreciate it, and I'll see you in the next video.